Okay, let's unpack this. Imagine a company that, despite all the global challenges we've seen, saw its revenue jump by a really remarkable 36% in FY 2024. We're talking over CNY 177 billion. That kind of scale, that growth, that's what we're diving into today. Welcome to the deep dive.
Yeah, so we've got the stack of sources you sent over, articles, research, analysis, all pretty much up to date as of May 28, 2025. And we're going to really dig into BYD Electronic. That's ticker HKG.0285 on the Hong Kong Exchange. And we're specifically looking at this through, a value investing lens. What does this all mean from that perspective?
Right. Our mission is, well, it's pretty clear. Cut through the noise. We want to understand what BYD Electronic actually is, how it makes its money, its financial health, the numbers, where it fits in the market, the big risks. And ultimately, what does all this mean if you're looking at this company right now?
Yeah.
Exactly. We're going to build up let's say, detailed picture. You'll see a company that's really leveraging its strengths, pushing hard into these exciting growth areas like new energy vehicles, NEVs, and AI. But at the same time, it's grappling with some pretty significant external pressures. Geopolitics is a big one, which leaves us with this big question, and we'll circle back to this at the end. Are its core advantages, its mudwut, if you like, really strong enough to handle all that complex, sometimes stormy environment?
All right, let's get into it then. And hey, while we're diving deep, just a reminder, you can get prioritized deep dives like this one. If you join Stock Analytics AI as a member, it's euro 4.99 a month. Just give us a ticker and we'll bump it up the analysis key. You can find the links to the sources we're using today down in the description, by the way. Okay, so first things first, understanding the business. What exactly is BYD Electronic?
Well, at its heart, it's a major global player in EMS, that's electronics manufacturing services, and also a component supplier. It was actually spun off from the bigger BYD Company Limited, the one famous for EVs and batteries. And BYD Electronic, or BYDE, has been listed in Hong Kong since 2007.
And they talk about offering one-stop solutions, right? So they can take an idea for a product and basically handle everything.
Pretty much. From the initial R&D using tech like AI, 5G, new materials, all the way through the design, the actual manufacturing, assembly, even managing the supply chain. It's quite comprehensive.
And that leads to this atoms to arts philosophy they mentioned. What's that about? It's their way of describing their vertical integration. They control a huge chunk of the value chain themselves, from the basic materials, the atoms that go into components, right up to the finished assembled product, the arts. From a value investor's viewpoint, that level of control, that potential for cost efficiency, that's definitely something you look at closely. Could be a source of competitive advantage, maybe part of a moat, but we need to see how strong it really is.
Okay, so what kind of things are they actually making? Let's break down that FY 2024 revenue. The biggest piece is still consumer electronics.
Yeah, by far. That segment brought in over CNY 141 billion in FY 2024, and the growth there was huge, almost 45% year over year. This covers manufacturing things like the casings for devices, metal, plastic, structural parts, plus assembly for smartphones, tablets, laptops, that kind of thing.
And who are the customers for this? Big global brands, I assume.
Exactly. Major global brands. And the sources really highlight one particularly significant U.S. client. Actually, this one client accounts for something like 48–50% of BYDE's total revenue.
Wow. Okay. That's a big concentration. Definitely something we need to remember when we talk about risks later.
For sure. But that segment's growth last year was driven by, well, new product categories, gaining more share with their overseas customers, and just a general recovery in the Android market.
All right, second segment, new intelligent products. Sounds futuristic.
It does, yeah. This is where you find things like AI servers, components for data centers, robotics, smart home stuff, gaming hardware, even 3D printers.
Okay, lots of buzzwords there. But the revenue
came in at about CNY 15.6 billion in FY 2024.
Yeah.
But here's the twist. It actually decreased by over 15% compared to the year before.
Decreased. With all hype around AI, that seems weird.
It does seem counterintuitive. The sources explained it was mostly due to pressure in the household energy storage business, which for some reason falls under this segment. But within this segment, they did have wins, like getting AI servers and 3D printers into mass production and developing new cooling systems for, high-performance computing. So it's kind of a mixed bag in that segment.
Got it. And then the third one, this seems like a natural fit. New energy vehicle or automotive intelligence systems, leveraging the parent company, right?
Exactly. This is a big growth story for them. CNY, 20.5 billion in revenue in FY 2024, and that was up over 45% year over year. Really strong. This is where they make things like intelligent cockpits for cars, driving systems, thermal management parts, suspension components, all benefiting hugely from the parent company's position in the EV market. It's a clear advantage.
And they didn't just rely on organic growth. They made that huge acquisition in 2023, right? Buying Jabil Singapore's mobility arm.
That's right. A big one, USD 2.2 billion. It included manufacturing sites in Chengdu and Wuxi in China. The idea was to beef up their consumer electronics side, aiming for more flagship projects with that key U.S. client we mentioned, and just deepening their skills in components and assembly.
But integrating something that big isn't easy, I imagine.
No, it takes time. And the sources noted added to their amortization costs in FY 2024, which hit their profitability. Making that integration work is really critical for them.
So looking at the big picture, where do they stand? Market position, scale.
They're a major player. Ranked 7th globally among the top 50 EMS providers in 2024. We're talking, like you said, CNY 177 billion revenue, market cap floating around HKD 73, 75 billion recently, about 150,000 employees. It's substantial.
Then geographically, where's the money coming from?
This is key. Only about 31.5% from mainland China in FY 2024.
Yeah.
The vast majority, 68.5%, came from overseas markets.
So very global, which means global opportunities, but also global risks, especially trade and politics.
Precisely. And that brings us to competition. They're big, but they're not alone.
Who are they up against?
The giants. You know, Foxconn, Pegatron, Jabil, even though they bought part of it Luxshare, it's a tough crowd. Competition is fierce, based on price, quality, speed, tech. Consumer electronics is notoriously competitive, cyclical. Auto electronics has big established players, and those new intelligent products, lots of specialized companies there too.
Okay, so let's go back to that moat idea. What are their strengths against this competition? You mentioned vertical integration.
Right. That, plus there's sheer scale in manufacturing, their R&D that Adams to Arts Tech focus their deep ties with major customers, even if concentrated. And, of course, the synergy with the wider BYD group, especially in automotive. These are the potential elements of their advantage.
Potential being the key word. How durable is that advantage?
That's the million-dollar question, isn't it? Especially in an industry that changes so fast and is so competitive. How sustainable is it? And that heavy reliance on just a few big customers, particularly that one U.S. client, that definitely adds vulnerability.
So diversifying customers and really succeeding in these new growth areas like auto and AI servers, that's crucial to proving the moat is real and lasting.
I think so, yeah. It's a major test for them.
And all this happens within broader industry shifts, right? OEMs outsourcing more, supply chains moving around this China plus one idea.
Exactly. Plus the growth in auto tech, AI, IoT, smart factories. These trends create openings, but also demand huge investment and flexibility from companies like BYDE.
And regulations. China is supporting manufacturing, but also more focus on data, cybersecurity.
Right. It's a complex landscape to navigate, both technologically and regulatorily.
So wrapping up the business itself, BYDE offers this integrated path from idea to product using tech scale quality. But the challenge seems to be making it consistently profitable at a high level.
That nails it.
Yeah.
And understanding all the model, the segments, the scale, the competition, that's the bedrock. It tells you what they do, where they are, and the forces shaping their future.
Okay, great foundation. Now let's pivot to who's actually making the decisions. Chapter 2, Management Evaluation. Who's running the show?
The CEO and executive director is Mr. Niancheng Wang. He's been in the role since 2015, has an engineering and MBA background, and importantly, deep history with the BYD Group, starting way back in '95. And the chairman is Mr. Wang Chuanfu, who's also the chairman and CEO of the parent company, BYD Co, Ltd.
Okay, so long tenure, deep roots in the group, seems stable at the top. What about their track record? The revenue growth, as we said, is impressive.
Absolutely undeniable. From CNY 73 billion in FY 2020 to CNY 177 billion in FY 2024. That's a fantastic growth story.
But the bottom line, net income, profit margins.
That's where it gets more volatile. There was a big dip in profit in FY 21, FY 22, and a strong recovery in FY 23. But then in FY 24, despite that huge revenue jump, net income only grew about 5.5%. It suggests that while they're great at grabbing market share and boosting the top line, turning that consistently into proportional profit growth has been, well, inconsistent.
So from a value investor's angle, experience is good, but effectiveness is key. Does that profit volatility raise questions about, say, capital allocation? Are the big R&D spends, the Jabil deal, really boosting long-term value or ROIC?
Those are exactly the right questions. How well are they navigating the competition, the geopolitical risks, while trying to shore up profitability? It leads straight into governance.
Right, and governance is extra important here because the parent company owns such a huge chunk, right? About 66%.
It's exactly. Around 65.76%. That controlling stake means strong governance is crucial to make sure minority shareholder interests aren't overlooked.
They have the standard structure, right? Executive directors, non-executives, including parent reps, and independent directors, INEDs.
Yes, and separating the chairman and CDO roles is generally seen as a positive. They have audit, remuneration, nomination committees, with rules about IND majorities as required by the Hong Kong Exchange.
The directors have relevant experience, long average tenure, seems stable.
It does. And compliance with HKEX rules is expected. The broader BYD group talks a lot about ESG environment, social, governance, even linking executive pay to it. How that specifically plays out at BYD needs a closer look, but the framework's there at the parent level.
But that parent influence, it's a double-edged sword, isn't it? Good for synergy, especially in NEVs, but potential for conflict of interest.
It's a classic challenge with controlled companies. Strategic alignment is good, but you rely heavily on the independence and effectiveness of those INEDs to protect minority interests.
Let's talk capital allocation then. Where's the money going? R&D is a big one.
Huge. Nearly CNY 4.9 billion in FY 2024, about 2.76% of revenue. Focused on AI, 5G, materials, auto tech, essential for staying competitive. But the question remains, what's the return on that investment? How efficiently does it turn into profitable products?
And capital expenditures. The sources noted something interesting. Net PCE actually decreased in FY 2024.
Yeah, that was an interesting observation. Net property, plant, and equipment went down slightly, even with significant depreciation charge. It could imply new investments were less than depreciation, or maybe offset by disposals, or how the Jabil assets were treated. You'd need a full cash flow statement to be sure, but it suggests the net expansion of their physical base might have slowed slightly that year compared to the prior one.
And then there's M&A, dominated by that Jabil deal.
Right, the $2.2 billion acquisition. Closed mid-2023, integration ongoing in FY 24, aimed at boosting consumer electronics, getting closer to that key U.S. client. But it comes with those ongoing amortization costs hitting the P&L, about CNY 230 million a quarter. Success depends heavily on smooth integration.
They also pay dividends, balancing returns with growth funding needs. FY 24 proposed final dividend looked consistent with their payout ratio, around 30%. And dividends have grown historically.
Yep, the sources didn't detail any major share buyback programs recently, but they did set up a share award scheme early this year for employees. That's another form of capital use, linked to compensation.
So the value investors take on capital allocation. They're investing heavily in R&D and M&A, returning some cash via dividends. But is it generating enough long-term value and ROIC, especially given the profit ups and downs?
That's the core question. Evaluating management boils down to their decisions, where they invest, how they handle challenges, and how they balance growth, profitability, and returns for all shareholders.
Which leads us perfectly into the hard numbers. Chapter 3, Financial Health. Let's look at that historical performance, FY20 to FY24.
Okay, looking at the trends, the standout, again, is that powerful, consistent revenue growth, hitting over CNY 177 billion, up 36% in FY24 alone. That's seriously impressive top-line momentum.
But then you look at net income, earnings per share, it's a bumpier ride. Big dip in 21, 22, strong rebound 23, then that relatively small 5.5% profit growth in 24 despite the huge revenue gain.
Right. It really underscores that theme.
Yeah.
Great at growing sales, but translating it efficiently to the bottom line, that's been inconsistent. Competition, cost of new ventures, integration costs, likely all playing a role.
Let's zoom in on those margins for FY 2024. Gross profit margin down to 6.94% from over 8% the year before.
Yep, and operating profit margin also slipped, down to 2.19% from 2.83%. Net profit margin ended up at 2.41%, down from 3.11% in FY23.
Those declines are significant. What's driving them?
It means cost production, operating expenses grew faster than revenue or gross profit in that period. Management mentioned business structure adjustments and needing time for new businesses to mature profit-wise. Plus, the sources flagged that margin pressure continued into Q1 2025, specifically blaming lower orders for some higher-margin consumer electronics parts. This is an ongoing focus area.
What about returns on capital? ROE, ROA, ROIC?
ROE was around 13.8% in FY24, ROA about 4.8%. ROIC, return on invested capital, the key one for value folks, was reported in a range, roughly 5.3% to maybe nearly 11% for FY24.
And how does that ROIC look?
Well, ideally, you want ROIC consistently above the company's cost of capital. That's how you create real economic value. The levels reported seem like they are above a typical cost of capital for this kind of business, which is good. But the trend, the consistency, that's what needs watching, especially with those margins under pressure recently.
Okay, let's look at the balance sheet. Financial strength, FY 2024 numbers. Assets around 90 billion CNY, liabilities 58 billion, equity 32 billion. How's the debt look?
Pretty manageable. Total interest-bearing debt with CNY 10.8 billion, actually down from 14.6 billion the year before. They had about 7 billion in cash, so net debt was only around CNY 3.8 billion. Reducing debt is generally positive.
Ratios, debt to equity, liquidity.
Debt to equity is conservative, around 0.33. Liquidity looks okay too. Current ratio at 1.19 suggests they can cover near-term bills. Quick ratio, taking out inventory, is around 0.83, still reasonable.
Interest coverage. Can they pay the interest on their debt?
Comfortably. The ratio is reported around 7.45x or higher. Earnings cover interest expenses easily. That's a sign of stability.
So summing up financial health.
Balance sheet looks relatively solid. Debt is under control. Liquidity seems adequate. The main financial flag based on these sources is really that pressure on profit margins and the struggle to turn top-line growth into consistent, strong bottom-line profit and, crucially, improving ROIC.
Right. The numbers really tell the story behind the headlines. Big revenue is great, but you need profit, you need returns, and the balance sheet tells you if they have the foundation to keep going and invest for the future.
Okay, let's shift perspective. What does the market think? Chapter 4, Market Sentiment. What are the analysts saying?
Overwhelmingly positive, actually. The consensus across multiple sources is strong buy or buy. Seems like a lot of analysts covering the stock are pretty bullish.
And price targets, do they reflect that optimism?
They do. Average 12-month targets mentioned are way above the share price from late May, which was around HKD 32.4. We're seeing averages cited in the HKD 46 to 52 range.
Wow. So that implies potential upside of, what, 40–50% or even more?
Yeah, based on those average targets, the suggested upside is substantial. That bullishness seems tied to expectations for continued strong growth in auto electronics, benefits from integrating Jabil and serving that key U.S. client, and maybe potential from newer areas like AI servers.
But has sentiment shifted at all recently? Any changes? There's been some nuance, yeah. After the Q1 2025 results came out, which some saw as a bit weak due to that margin pressure from consumer electronics parts, some analysts did trim their price targets slightly. Lion, for example, lowered theirs, but kept an outperform rating. But others doubled down, reiterating high targets. And some took a more cautious stance, shifting to neutral. So the Q1 results definitely caused a bit of a reassessment, tempering some near-term enthusiasm maybe.
So the big picture from analysts is still positive, but with maybe a bit more caution about near-term profitability execution after Q1.
Exactly. Balancing that long-term growth story against the immediate challenges. The sources didn't give us much specific recent data on things like short interest or options activity for BYDE specifically, so we're mainly going off analyst views here. Though, as mentioned before, there were general reports of insiders buying over the past year, which usually sends a positive signal.
Right. Analyst ratings give you that snapshot of expectations, but you always need to look at why they think what they think and how things change when new data comes out, like those quarterly numbers.
Okay, Chapter 5. Ownership structure. Who actually owns this company? It matters because owners influence direction.
And the big owner, as we've said, is the parent, BYD Company Limited, holding around 65–66%.
Right, about 65.76% as of the end of 2024. That gives them significant control. Good for strategic alignment, accessing group resources, especially for the NEV side. But, like we discussed under governance, it raises that potential issue for minority shareholders if the parent's interests diverge.
Who else holds significant chunks? Any big institutions?
Yeah, the sources list some major global names. BYDDF Trust, Vanguard, BlackRock, Norges Bank, holding stakes from maybe 0.5% up to almost 5%.
So big, sophisticated investors have put money in. That's usually seen as a vote of confidence, right?
Generally, yes. It suggests they've done their homework and see potential.
What about insiders? Management owning shares?
The CEO, Mr. Wang, holds about 0.38%, Total individual insider ownership is around that same level, 0.385%. Not a huge percentage overall, but it does create some alignment.
And any recent insider buying? We mentioned general reports.
Yes. The sources noted insiders were net buyers over the past year. One specific example mentioned was an executive director buying shares back in September 2024. Even if slightly outside the tightest date range, it shows that kind of activity was happening.
And insider buying is typically seen as positive, right? They know the company best.
Often interpreted that way, Shows confidence from within. So ownership paints this picture. Dominant parent with pluses and minuses, validation from big institutions, and some positive signals from insider activity.
Okay, that leads us into the really challenging part. Chapter 6, risk assessment. What could go wrong? And based on the sources, the big one seems to be geopolitical risk, specifically U.S.-China tariffs.
Yeah, that really jumps out the elephant in the room, you could say. And it's incredibly complex.
How complex?
Very. The sources describe multiple layers just from the U.S. side. As of May 2025, you've got standard duties, then Section 301 tariffs on electronics up to 25%, then another 20% China IEPA duty. Then this reciprocal duty, currently 10%, but could jump way higher. And these things stack. Plus, there are separate 25% tariffs on vehicles and parts from China. Even low-value shipments lost their easy pass-through and face hefty duties now. It's a lot.
Wow. So for BYD, with so much overseas revenue and that huge U.S. client, how does this potentially hit them?
Directly on cost, first and foremost. Tariffs mean higher cost of goods sold for anything made in China going to the U.S. That forces a tough choice. Eat the cost, hurting already pressured margins, or try to pass it on, risking competitiveness and demand. That margin squeeze we saw, tariffs make it worse.
And it must push them to rethink where they make things, that whole China plus one idea?
Absolutely. It's a huge driver for diversifying manufacturing. BYDE has operations in Vietnam, and management says they expect using overseas production to limit the tariff impact. That's their main counter-strategy. But moving production isn't cheap or easy. And critically, those Jabil sites they bought, which are important for that key U.S. client, those are in China.
Right. And higher costs eventually mean higher prices for consumers in the U.S., potentially hurting demand for electronics or cars using their components.
Exactly. The sources mentioned projected rises in U.S. vehicle prices due to tariffs, which hits their auto segment. And the constant uncertainty around tariffs makes long-term planning incredibly difficult.
So even with mitigation plans, these tariffs are a massive external risk factor for BYDE, given their business mix and customer base.
A really substantial wildcard, yes.
Yeah.
It could directly impact their financials and growth.
What other specific business risks came up in the sources?
Well, we've hit on several already. That high customer concentration, almost 50% revenue from one client, the cyclical nature of consumer electronics, the ongoing margin pressures, intense competition everywhere they operate. Also, the risk that the Jabil integration doesn't go smoothly or deliver the expected benefits, the need for constant R&D to avoid falling behind technologically, general supply chain risks beyond tariffs, and that potential dependence on the parent company influencing decisions.
Plus broader macro stuff, economy, inflation.
Yeah, general U.S.-China relations, global economic slowdowns, inflation, interest rates, currency swings, all the usual macro suspects that affect global manufacturers. Management acknowledges this volatile external environment as a key challenge.
So the risks aren't abstract. For BYDE, you've got significant geopolitical headwinds layered on top of tough industry dynamics, customer concentration, and that core challenge of consistent profitability.
That sums it up well. Navigating that complex mix is really the central test for management and the company's future.
Okay, let's bring it all together. Chapter 7, Conclusion. What's the final picture from this deep dive?
Well, BYD Electronic is clearly a huge scaled EMS player. Impressive top-line growth, especially recently. They're pushing into exciting areas, NEV auto systems, AI servers leveraging that integrated model and tech capability. And the balance sheet looks reasonably solid, providing some stability. Plus, analysts are mostly optimistic about the future.
But there's always a but, isn't there?
There usually is. The big but here is the inconsistent profitability. Translating that fantastic revenue growth into strong, steady profits and margins has been a challenge, as the recent numbers show. They face fierce competition, rely heavily on that one big customer, are still digesting a major acquisition, and all of this is happening under the shadow of those significant geopolitical tariff risks.
So it's a real balancing act, growth potential versus profitability challenges and external risks. What about valuation? Is it cheap?
The sources suggest it's moderately valued. PE around 15-17x. Price to book around 2.1x. not deep value territory. Those bullish analyst targets rely on BYDE successfully executing its growth plans and managing all those risks effectively.
So for this to be a really compelling long-term value play, what needs to happen based on our analysis today?
Several things, really. They need to successfully grow and, crucially, improve margins in those new areas like automotive and AI. They need to effectively navigate or mitigate the tariff impact. Diversifying their customer base seems important too. And ultimately, they need to show they can generate strong, consistent returns on invested capital, clearly beating their cost of capital over time.
Given all that, what's a prudent takeaway?
Caution seems warranted. You acknowledge the growth potential, the scale, the tech. It's impressive. But you have to weigh those significant risks heavily. The tariffs, the customer concentration, the profitability consistency. It means you'd need to watch management's execution very closely and keep a sharp eye on how that whole geopolitical situation evolves.
Which really brings us back to that final question, doesn't it? You have this company with huge scale, big ambitions in future tech like auto and AI, pushing this atoms to arts innovation. But can that approach truly build an economic moat, durable enough to withstand the constant profit pressures of the electronics world and the major storm clouds of global trade tensions? Or is BYDE navigating a sea that's just going to stay rough and unpredictable for the foreseeable future?
That's a really potent question to leave things on. Thanks for joining us for this deep dive. And remember, you can support analyses like this by becoming a member of Stock Analytics AI on YouTube. Check out the links. And just a standard reminder, everything we've discussed here is for informational purposes only. It's based strictly on the sources provided to us, current as of May 28, 2025. It is absolutely not investment advice. While AI may have assisted in analyzing and structuring this information, it's all derived from the source material. Please, always do your own thorough research and consult with a qualified financial professional before making any investment decisions.
Thanks for listening to The Deep Dive.